Most people don't realize this, but when they buy a stock, they often don't fully understand what they're actually purchasing. To many beginners, a stock just looks like a ticker symbol on an app that goes up and down. It feels abstract, almost like a game or a number you trade for profit. Because of that, people tend to focus only on price movements instead of what's underneath. This confusion leads many investors to panic, overtrade, or give up entirely. But once you understand what a stock truly represents, investing becomes much clearer and a lot less stressful. Welcome to Aaron's Money Manual, where we simplify money so you can stress less, live more, and actually make your hard-earned cash work for you. If you like beginner-friendly investing explained clearly and without hype, make sure to subscribe for weekly videos. A stock is not just a price on a screen. When you buy a stock, you are buying ownership in a real company. That means you legally own a small piece of that business. You're not lending money to the company, and you're not placing a bet. You are becoming a partial owner, even if that ownership is very small. This idea alone changes how you should think about investing. To make this easier to understand, imagine a company as a pizza. The company cuts that pizza into a certain number of slices, which are called shares. If the company has 1 million shares and you own one share, you own 1/1,000,000th of that business. You don't control the company and you don't make day-to-day decisions, but you still own a real slice of it. That's exactly what a stock represents. Because you're an owner, you're entitled to certain things. As a shareholder, you have a claim on a portion of the company's profits, a claim on its assets, and in many cases, the ability to vote on important company decisions. You may never personally exercise those rights, but they exist. When a company grows, becomes more profitable, or gains value, your ownership becomes more valuable as well. When a company struggles, your ownership loses value. The stock price simply reflects how valuable that ownership is believed to be at any given moment. This is why stock prices move. Prices change because investors are constantly reassessing what a business is worth. If people believe a company will make more money in the future, expand its operations, or gain a competitive advantage, demand for ownership increases and the stock price goes up. If people believe profits will fall, costs will rise, or the business model is weakening, demand drops and the stock price falls. You're not trading symbols or charts, you're trading expectations about real businesses. One of the biggest mistakes beginners make is thinking a stock is cheap just because the price is low. A $5 stock is not automatically cheaper than a $200 stock. What matters is the total value of the company and how much of it you're buying. A company with a low share price can still be extremely risky or overvalued, while a company with a higher share price can be very stable. When you understand that stocks represent ownership, price alone stops being the main focus. Thinking like an owner also changes how you invest long-term. Instead of asking whether a stock will go up tomorrow or next week, you start asking whether the company is strong, profitable, and likely to exist years from now. Long-term investors don't obsess over daily price swings. They care about business performance, cash flow, and sustainability. This mindset shift is one of the biggest differences between successful investors and people who constantly feel stressed about the market. Here's a simple example. Imagine you own shares of a coffee company. If that company opens more locations, builds a loyal customer base, and increases profits, your ownership becomes more valuable over time. But if sales decline, competition increases, or costs spiral out of control, your ownership loses value. The stock price is just the scoreboard. The business itself is what actually matters. Understanding this also helps control emotions. Many people panic sell during market downturns because they see prices falling and assume something is wrong. But if the underlying business is still strong, temporary price drops don't change what you own. When you view stocks as ownership instead of trades, it becomes easier to stay patient and consistent. And consistency is one of the most important factors in long-term investing success. Stocks are not designed to make you rich overnight. They are designed to allow you to participate in the growth of real businesses over time. When people treat stocks like lottery tickets, they get disappointed. When they treat them like ownership stakes and give them time to grow, investing tends to work the way it's supposed to. So to recap, a stock represents ownership in a company. It gives you a small piece of a real business, ties your results to that company's performance, and reflects what investors believe that ownership is worth. You're not buying a chart, a prediction, or a shortcut. You're buying a slice of a business and betting on its long-term success. Thank you for watching Aaron's Money Manual. I really appreciate you being here and taking the time to learn how investing actually works. If this video helped clear things up, Feel free to check out some of my recent videos on the channel where I break down money and investing in a simple, practical way. I post regularly, and I'd love to have you back for the next one. Thanks again for watching, and I hope to see you next time.